Yo, what is going on, everyone? Thank you so much for clicking on this video. In this video, I'm going to be breaking down my continuation model, pretty much a complete breakdown of every single step, other ways I look at it, how I find it from opening the charts on my PC to literally actually starting to find it and then actually executing a trade on it, and how I do so. So this is going to be a bit of a longer video than usual just because I'm going to be diving into every single topic pretty much kind of in depth, more than usual. So expect a longer video, get your popcorn ready. But if you watch this entire video, I guarantee you will learn something new and it should help you out when day trading. We do actually have a completely free Discord where we post every single trade, no BS, lose or win. We're super honest and clear and transparent. If we lose the trade, we also break it down. As you can see, completely, this was a loss. Break it down, everything we liked about it, what went wrong. And sometimes a losing trade isn't a bad trade, just it's a good trade. And that's just the losing probability because you're not going to win every single trade. But we break down every single trade, win or lose, right here on the free Discord. We also have a completely free course that was made in-house as well by our boy. And we have a bunch of things and resources for you to get started as well. So if that's something that's interesting to you, go ahead and check out the link in the description and join the free Discord there. Now, let's go ahead and start diving into it. There's going to be a raw, unedited video, so please make sure you stick through the end to actually learn something new that can be super useful for you. You might be hearing me coughing a lot, but deal with it. So this is my continuation model. I'm going to be doing a complete breakdown. I'm also going to give you other tips on trading. I've been personally trading since I was in the 8th grade is when I started learning. Now, obviously, I didn't take it seriously then because I would go to school every single morning and I wasn't able to trade in the morning. But I did learn the basics up until freshman year of high school. Then I took a little break. And then senior year of high school, I got back into it. I'm now a sophomore in college, and I turned profitable in 2023, getting my first about 6 payouts from funded accounts, giving me about 5 figures in profits. So let's get right into it. This is the model I'm going to be using to scale up to 6 figures and more in the future. And yeah, I'm just giving y'all the sauce right here straight up with no BS. So let's get right into it. I'm going to go ahead and delete this, and we're going to break down into a couple of steps. First thing is, this is going to be about the actual entry model. I'm going to break it down step by step literally for you. So the first thing that I'm looking for is, first thing we're going to do, open the charts. We're going to go to the 4-hour time frame, okay? 4-hour time frame. 4-hour time frame. Now, why are we looking at the 4-hour time frame? Because the 4-hour time frame tells us a few things. So the 4-hour time frame tells me where market is likely to go that day / session. Okay, so by looking at the 4-hour candles, I can see where the market is likely to go that day. It also tells me here, let me make bullet points for y'all. Oh, it didn't turn into a bullet point, whatever. Y'all get the point. Where the market is likely to go that day. Okay, so that's going to be the first thing we'll identify, and I'll show you how I identify that once we go into the 4-hour time frame. The 4-hour time frame also tells me what trend the market is currently in for that day as well. So what trend we're in. And the 4-hour time frame, sorry, I'm scratching my nose, also tells me where are we likely to retrace before continuation, right? So this is all inside of the 4-hour time frame. And I'm going to show you that right now. Now, mainly the points that I want to find here with the 4-hour time frame is, I'll make these ones a little bit bigger. Our draw on liquidity. Now, what is our draw on liquidity? Draw on liquidity, this is basically where do we think the market is headed to next? The next draw on liquidity. And if you didn't know, markets move from internal to external liquidity when they're in a trend. Until they break trend, then obviously it switches. So when we're in a trend, for example, I'll just zoom in here real quick and show you guys an example. So markets move from internal to external liquidity. It's easier if I show you on the 4-hour because there's less BS here. So for example, let's go right here. I'll delete all of this. So from this point to this point, actually this whole area after this, what trend are we currently in? This market right now is in this is a 4-hour. this is in a bullish trend, so upwards trend. So what is this telling me? So in an upwards trend, the market is going to take out external liquidity at highs, usually, and then push back into internal liquidity, which is inside of the range, and that's going to be seen right here. So let's say if we mark out a trend, we got highs, lows, highs, lows. Now external liquidity is going to be these highs, right? Highs, and also going to be the lows. But in an upwards trend, we're not going to be taking out the lows as much. We're going to be taking out the highs. So that's going to be our draw. Now, how does this actually help us? Internal liquidity is the liquidity that's built up inside, obviously internally, of the range. So the internal part of the range. So in the internal part of the range, we have fair value gaps. Fair value gaps are just areas of displacement where there's likely a retracement to happen because of the strong displacement to, in this case, the upside. So there's orders to be filled here, quote unquote. You can say whatever you want, but basically it's just an area for high likely chance for price to retrace into. So let me remove that from there. And once you understand how the markets move, then it's a lot easier. You want to be targeting that external liquidity after taking a trade off of internal liquidity. So what does that actually mean? So we're going to be using fair value gaps. If you don't know what a fair value gap is, I'll explain that real quick as well. Again, I want this to be a really good video for you guys. If you like this video at all and I help you out at all, make sure you drop a nice comment and hit the like button and subscribe for more videos. I have so much content on my YouTube. I post pretty much every day. But let's go ahead and keep going. So a fair value gap is the space that's created by 3 candles. The middle candle, in this case, this one right here, generates this space right here. And as you can see, what I drew it from is the previous candle, the wick, and then the last candle, the third candle, its bottom wick. This is going to be a bullish fair value gap. We extend that out, and as you can see, in an upwards trend, price tends to respect it. We wick through it, fill all the orders, fill the imbalance, and now we can proceed to continue upwards. This is what you want to see in an upwards trend. Now obviously in a downwards trend, it would be the opposite. We would have a fair value gap get generated, for example, like this right here. Boom. So this is a bearish fair value gap. It's created by a red candle. Now, in this case, the market actually doesn't respect it because it's still in an upwards trend, right? So that is what you want to see in a bullish trend. If we do get bearish fair value gaps, you want to see them get disrespected. And real quick tip that we're going to be foreshadowing for the future of this entry model is that this actually is an inverse fair value gap. So when we close above a fair value gap, so let's say this is a bearish fair value gap, a red candle created it, right? From this shadow wick right here to this wick, we end up getting a closure above the fair value gap, which is this rectangle right here. That is now an inverse fair value gap. So if we inverse a bearish fair value gap, bearish is red. If we inverse a bearish fair value gap, that is a positive sign, a bullish sign. And as you can see, that's why we tend to continue pushing forward. Okay, after we also retest it again. All right, so we completely flip bias on this. So buyers are still more powerful in this trend. That's why you don't want to play against a trend, okay, unless you get strong confirmation. So a lot of people may have thought, okay, we just created a bearish fair value gap here, we're most likely going to retrace. No, remember, trend. Play with that trend. Play with that trend. Okay, so enough yapping. Let's get right back into it. So the 4-hour candle. Also, what I want to break down, let's say you're trading at 9:30 a.m., right? 9:30 a.m. is when the New York market opens, okay? 9:30 a.m. The 4-hour candles open up at 10 a.m. Eastern and 2 p.m. Eastern if you're trading the New York session, okay? So market opens at 9:30, 10 a.m. and 2 p.m. So 9:30 is going to be super volatile. I personally don't like to trade between 9:30 and 9:55. I just wait for 10. Now part of this model. There's tons of strategies out there. I'm just breaking this one down, which is the one I'm going to be using to trade. It's the one that makes the most sense for me at the moment. And this is why it makes sense for me. So 10 a.m. and 2 p.m. Again, if you already know this, don't skip through. I'm going to be breaking stuff down just pretty quickly here, okay? So at 10 a.m., this is the one I'm going to be trading. What do we know about candle anatomy? So let me go to a 10 a.m. candle, for example. All right, there we go. Perfect. What do we know about candle anatomy? So candles form an open. The open of a bullish candle is the bottom of the body right here. Okay. The top is the close, voice track. And then we also have a high that gets put in. And then we also have a low that gets put in. But what do we know about the order that these things most likely happen when these candles are created? So typically, you'll see a candle get created with an open. Well, also, we're talking about a bullish candle here since we're in a bullish trend for this example. We have an open. The open is right here, right? Open. Oh. Open. We create a low, which is going to be that bottom wick. Because obviously, if it's going to end up closing as a green candle, it's not going to be putting in this wick at the end. So this is the second thing that it's going to put in most likely. It may go up a little bit and then put that wick, but we're going to get that wick before the majority of the move that we want to happen happens. So open, then we put in a low of a candle. Then we put in a high. The high, obviously, we most likely won't close at the high because that's just super unlikely timing. Unless we're just going up and going up, we'll most likely put in a top wick because that's just how candles work most of the time. And then we'll close. So it'll be an open low. So we open, put in a low, generate a high, then we close, right? So that's a bullish candle. Now, why I like using the 4-hour candle, I've been learning about this myself from other people and kind of mixing concepts in for myself, and now I'm breaking it down to you, spitting it out, is because the 4-hour candle tells us what is going to happen in that morning session that most people trade from 10 a.m. to 2 p.m. And still, the bulk of the move happens from 10 a.m. usually to about 11:30 in the morning. Maybe in the PM you get even more moves, but the bulk of these moves with the most volume happen between that 10 a.m. and 11:30, which is where most people trade. So why not understand the anatomy of that move that happens every single day at that time, typically? And you can see that entire move in one candle, and that is a 10 a.m. 4-hour candle. So that's why I love this candle, and it helps me understand the market a lot clearer. So if we're in a bullish trend, right? What did we say earlier? To find or draw on liquidity, we are expecting price to take out that external liquidity. So let's say we're trading this day, which our team actually traded. So don't think about anything past this candle. We're looking to trade this 10 a.m. candle. So we can only see this, right? Oh, we can only see this, right? On the right side. Okay? So I'll draw a line for y'all. Boom. Okay? Everything before this. So what is the 4-hour currently in? We're going to do step by step. Trend, question mark, bullish. And this is all a 4-hour checklist. Trend is bullish. Okay, cool. Identify a high, like previous last swing high. Okay. Identify fair value gaps on this time frame that price can retrace to. Identify fair value gaps for price to retrace into. Once we do that, that's pretty much all you do on the 4-hour time frame. So first step, trend. Okay, we know we're bullish because we're making higher high, higher low, higher high, higher low. We've made a higher high now, and this can potentially become a higher low if we manage to break structure to the upside. Now, what do we know about bullish structure as well? What do we know? It's super simple. In bullish structure, higher highs need to be put in for structure to maintain bullish. Higher highs need to be put in for structure to maintain bullish. What does that actually mean? So we have this high. If we do not break this high by a tick, we will not continue bullish structure. But we are expecting to continue bullish structure because of what price is telling us. And what is price telling us? It's right here. Price is telling us that we have retraced into this fair value gap. This one right here, which is at step 3. We have already identified the swing high. Swing high is right here. Boom. So we know the trend is bullish. Identify the swing high. This is right here. That swing high is going to be our target. Okay. This is going to be our target, our draw on liquidity, where price is likely headed to next, because we are in an uptrend and we have shown and price has told us that we are respecting bullish patterns. And what is the bullish pattern that we're respecting? Filling imbalances, retracing to a discount of the last leg up to continue a further push upwards. Okay. When price stops doing this, let's say we got a red close right here, that's already a bad sign, and I do not want to be taking longs at that point, okay? So we want to align ourselves with that trend and align ourselves with how price is respecting that trend, okay? We do not want to be taking longs when price is literally disrespecting the upwards trend. It doesn't matter if we're currently in an upwards trend. We want it all to align. That way our trade can be as high probability as possible, okay? So as you can see here, that 2 a.m. candle respects it. We still don't get a closure. We fill that whole gap. It's not a coincidence, boys. We fill the gap pretty much to a T. And then what do we get? Closure above. Candle closure above. We get a bigger candle, which is the one that we're going to trade. And what happens? Obviously, we put in that lower wick first. And what is that? Okay, I just deleted it. Right? So now we're ready to move into the lower time frames. We've identified our drawn liquidity, which is going to be our target for that day, for that morning session, these highs. Now we just need to hop in and identify, bro, how am I going to actually take an entry? Am I just going to long off the 4 hour? No. We're going to go into the lower time frames and identify an entry from the 1 minute to the 5 minute time frame. So let's go ahead and hop into the 5 minute, for example, and we'll just start scouting down from that time frame and going down. So go into the 5 minute. Boom, boom, boom. Let's see where our fair value gap is, right here. Okay. Fair value gap is right here. So now that we've identified and completed our 4 hour time frame analysis. Oh shit. So 4 hour time frame analysis complete. Next we want to do our lower time frame entry analysis. So what is this gonna consist of? So obviously I'm not trading in the middle of the night because I'm sleeping. So we're gonna wait until 10 a.m., which is where we always wait for 10 a.m. to happen. And we want to see that manipulation. So typically how the markets move and how a candle moves is in that AMD format. So you'll see that a lot around social media. AMD, what does that mean? So accumulation, manipulation, distribution. Now, what does that actually mean? Accumulation, it may be a little hard to see sometimes, but the main things that you want to focus on is a manipulation, which is that lower wick. We manipulate first, take out lows, take out liquidity, just form a lower wick because that's just how candles move, right? That's how the market moves. We must go lower before we can go higher. So manipulation. And then I'm actually going to tie them all here. So manipulation happens right here. So what do we do right at 10 a.m.? 10 a.m. is right here. We open, we dump, take out the last swing low on the 5 minute. We go down. Then what do? We begin to distribute in the direction that we actually want to go, right? We start distributing up here. We break up, we retest, and then we splooge up, right? So remove all that. So this box is that bullish fair value gap on the 4 hour that we were looking at. So now what are we going to do for the lower time frame analysis? Here I'm on the 5 minute. I'm actually going to hop into the 1 minute, and then I'll hop on to the higher time frames from there. I always start from the 1 minute and go up from there. Oh, it won't let me go to the 1 minute. I don't pay for trading view, so don't judge. All right, and right here we're on the 3 minute. Okay, cool. So there we go. Okay, this is beautiful anyway. So 10 a.m. happens right here. 10 a.m. opens. We go down. We take out this low. So this is manipulation, right? Remember, always the why I wait for that 4 hour candle to open is because that lower wick is going to be put in and most likely stop out a lot of people. Also, a lot of volume goes in at 10 a.m. A lot of volume. Typically, there's actually news there as well, which is likely what happened here, which is why we went up and down like this. But wait for that bottom wick to put in. We put it in. And we want that bottom wick usually to retrace into a fair value gap, okay? That bottom wick of that 4 hour, we want it to retrace into that fair value gap because we wanted our trade. I will only take a trade if it's delivering off of a fair value gap that's aligned with the trend. That's aligned with my draw on liquidity, okay? I'm not going to be trading against that. So here, what do we get? Right at 10 a.m., we open, we dump down, where are we? We're inside of that purple box, that bullish 4-hour fair value gap, meaning we are in an area for price to likely continue to deliver off of. So what do we get? We're on the 3-minute time frame. Right at 10, we identify a fair value gap here. But first, before I show you that, let me actually write down the steps for you. So now what do we want to see on the lower time frame? We want to see that retracement into it doesn't have to be a 4-hour, in this case it is, but just a higher time frame fair value gap. So higher time frame fair value gap, retracement into higher time frame fair value gap, and we get that right here. Okay, check. Second thing we want to see an inverse, or another thing actually you want to see is a sweep, internal sweep of liquidity. It's not necessary, but it is nice if you do get it, so you can clearly see that, okay, this is the manipulation leg. So for example here, this was the little sweep that we got internally. And then third thing I want to see now, for us to be ready to, okay, I'm confirming that we're ready to displace, we're ready to take off in my direction, and I have now put in a protected low that I will use as a stop loss. We're going to be looking for an inverse fair value gap, which we talked about earlier. And how do you actually find that? So after 10, we're going to identify a fair value gap in the opposite direction. So here we get a bearish one since we're looking for longs. I'm going to color that boy blue, or yeah, I'm going to color that one blue. So we have the blue one. What do we see? As you can see, here we failed to close above it, right? We failed to close above it. I'm waiting for a close above because that would be an inverse. So here we reject it. We chop. Finally get a closure above. That's exactly what I want to see. Finally get a closure above with strength. As you can see, we get nice 3 chunky, thick green candles that go upwards. And now we have successfully inversed. What is the next step I'm looking for? That's not all. I want to make sure that we're starting to break structure back to the upside, because that is a break of structure is the birth of a structure shift in the lower time frame or any time frame. But here, the manipulation caused a downwards or a bearish shift of structure. But now I want to confirm, since we're going to take longs, I don't want to enter before we start to break structure to the upside. So what I'm going to wait for is a change in the state of delivery or a break of structure if it's close enough as well. But what a change in state of delivery is what it sounds like. We're changing the state in which the price is delivering from. So if we're delivering from a bearish state, that's what this looks like right there. So how you find this is go to the last low that was put in. If you're looking for long, so the last low that was put in was here, right? This wick right here. So this wick right here, follow it up. Where did it come from? Right here. Came from the top of this body right here. So mark out the body. That's where it delivered from. That's where the move delivered from, because that is the body. Now break of structure would technically be like a wick like that or that. That's why I don't like to go with break of structures, because the wicks are just huge. But change in state of delivery, you can typically find those lightning entries where as soon as we break it, retest, we shoot off. So this is what I'm looking for. We get the inverse fair value gap. We got the change in the state of delivery. In this case, we got it with the same candle that got us the inverse, which is not too likely all the time, so don't always expect that. Usually the change in the state of delivery will be higher above the fair value gap, but here we get in the same candle, which is good. Okay. And then what do we do after that? Now for the actual entry, it would be a retest onto the change in the state, or if it's a really big difference and the stop would be way too big, it would be into the inverse fair value gap. Okay. So in this case, we took it off of the change in the state, which was right here. So we closed above, then set entry, boom, set entry, stops at these lows, the last lows, and then basically, I just moved that. And then after that, you can just target. If we go to the left, we see these highs. That was our highs that we drew out when we drew those out right as soon as we woke up and opened the charts. And that's our draw on liquidity. So it's going to be this one. Okay. And now let me go ahead and move this. Oh, I'm going to just delete these for y'all real quick. Target those. And that gives us a 2R. And yeah, you can even target more, obviously, and just get running up for a long ass time. So even if you target that one or target this one, if you target that high one, you get that 2R on the dot. Yeah, I typically go for 1 to 2 Rs. Now we'll talk about risk management now that we've gone over pretty much the entire entry model. And I'll skim through it again real quick if you didn't get it. So first thing we want to do, 4-hour time frame, identify the trend. As we can see, we're going up on this trend, right? Going up. Second thing we want to do is identify our drawn liquidity. Since we're in an upwards trend, we're going to put out that swing high, the last swing high, to get taken out, because for a trend to continue, if we're in an upwards trend, we need to put in another high, whether it's literally a tick above. It doesn't matter. If we put in a new high, we're still in an upwards trend, okay? So we want to make sure that if we're going to continue in an upwards trend, first thing that the market needs to do is take out this high. So that's why we put our target there, because we know that if we're going to continue this trend, market has to take out that high. If you put it any higher, you don't know if the market is going to keep going if we're still in an upwards trend, because it could literally stop anywhere. Here. Obviously, it didn't stop until like way up here, but you do not know that. So play it safe. I do that. For my actual stop loss, I always like to do a protected low. I made the mistake the other day of not using a protected low because it was too big. Guess what? I got stopped by a tick, and then it went in my direction and hit my TP. So this is why, don't make that mistake. I'm putting y'all on game. Use the most protected low. Typically, the low that you want to use is going to be that bottom wick of that 4 hour that gets generated. In this case, it was right here. So just use in this area, okay, these lows. Ideally, this one, if you can manage your risk properly, obviously. Now, I'm going to put y'all on some game about how I actually take profits. Now, people have different opinions on this, but this is just what I think and what works for me. And I literally have a chart. It's in the free Discord, I believe, or just join and I'll send it to you. But I took an unprofitable strategy, which was literally like a coin flip, 50-50, 1 to 1R. I took it from break even / unprofitable to profitable by doing this one thing. And it boosted the win rate by about 5 to 6%, which turned it profitable. It went from like a 48% win rate on a 1-to-1 to like a 54% win rate or more. I don't know. So it literally, just by doing this, no technical analysis at all changed. Nothing changed. Took a gambling strategy to an actual profitable strategy by hairs. But it just goes to prove that it literally helps. And what that is actually just when you're trading and entering a trade, let's say you do, let's say you do set your stops at this low right here, for example, doesn't matter. You're always going to have a 1-to-1, okay? So whenever you have a 1-to-1, which is right here, moving stops to break even. Protected low if you use a protected low. Move stops to break even. 1-to-1 is right there. There we go. So you use that protected low. That's going to help from you to get stopped out, right? Because prices may chop around for a bit. Also, real quick before I tell you guys, if you have a stop loss, the whole point of a stop loss is don't be scared if price comes down here. The point of a stop loss is we're giving all this red space to the market up until our actual stop loss for it to go down and then end up moving. You shouldn't be expecting price to just boom, hit your entry and then take off, bro. Like, give it that space. That's why we give it that space. Don't be scared in closing entries here once we get down here. Give it that room. Be patient and stop being stupid. Okay? Anyways, once you hit a 1-to-1 R on your trade, I personally will either, maybe I'll trim contracts depending on how price action is developing, or I might not trim contracts. But that's not what I'm talking about. What I'm talking about is moving your stop loss to break even when you hit that 1-to-1 R. By moving your stops to break even when you hit that 1-to-1 R, you are now not allowing a winning trade to become a loser. You may allow a winning trade to become nothing, but you do not want to be losing money after being up like this. Now, maybe this sounds stupid to you, but again, this boosted my win rate for a 1-to-1 and not for a 1-to-1. This boosted my win rate for 1 to 2 by a couple percents as well. So this stuff helps. A lot of the time people wait for it to get up here and then they still don't move stops. Bro, if it gets way up here, move stops to break even, because now you're protecting yourself. Why the hell? I noticed literally. So whenever you would hit a 1-to-1 R, if you have a protected low, right? If you're taking a trade off of a protected low and your trade hits a 1-to-1 R, I noticed that when it hit a 1-to-1 R and then it returned and retraced back down to this area, your entry area, usually it just runs the stops, bro. Okay? So that's why I do it. I noticed that it helped me boost my win rate. You can check every single trade I've taken in the free Discord. Literally, it's all in here. Every single trade I've taken. Check how many break evens I have and how they help my win rate. I post pictures of every single trade as well. So check everything, bro. And you will see. Oh my God, funny enough, bro. This is actually the trade. What the heck? All right. So join the free Discord, link in the description if you guys want to check it out. We have everything in there. We also have a 7-day free trial if you actually want to trade live with me and my team. It's not just me. People who actually trade even better than me trade live every single morning in the call. We have 3 of us, and all with different strategies and all with different experience. So if you want to ask any questions, hop in there. It's 7 days for free. You literally don't have to pay a dime, and then just join us and check out what we're doing and how we trade funded accounts. Now, if this video has helped you out at all in any single way, make sure you drop a comment that is nice. I love a lot of people have been dropping nice comments. I post every single nice comment on my Instagram story. And if this video helped you out at all, make sure you like, join the free Discord, and subscribe to the channel as well. And I'm just trying to think of if there's any other stuff I can give y'all right now from this entry model. Not really. I mean, this was pretty much breaking it down. There is another thing I do look for, which is SMT divergence, but I will break that down in a separate video, and I have broken it down in separate videos. But all of that is on my channel. Again, thank you guys so much for watching this video. If you have any questions, comment them below. Shoot me a DM on Instagram. Join the free Discord. Shoot me a DM on Discord. And let's start chopping it up. I'll see y'all in the next video. And good luck this year. This year is the year you scale up. Peace.